There's definitely more optimism this year than was the case last year. It's scarcely surprising. Last year, people felt that we were facing a Great Depression Mark II, that the global economy was falling off a cliff. We seem to have perhaps reached a sort of platform halfway down the cliff. Things have stabilized and people were feeling quite a lot better. I think the mistake is to suggest, though, that because things are looking better, we're back to a kind of normal world, if normal is defined as where we were 3 or 4 years ago. There are still huge challenges out there. It's a really bumpy road ahead of us, and I'm not sure that we're really facing the kind of proper recovery we'd like to see. Certainly in the Western world, maybe in the emerging markets, looking quite a lot better, but for the West, still some difficult times ahead.
You say you don't think we're facing it. What do you think needs to be done that's not being done?
Well, I think one of the big questions at the moment is what happens in terms of policy, macro policy, monetary policy, fiscal policy. The fact of the matter is that the Western world is still on what you might describe as life support drugs. It's been incredibly dependent on remarkably low interest rates. In the UK, for example, interest rates are at a 300-year low. So the idea that this necessarily proves that we're coming through with a strong recovery when stimulus is so big, I think that's an open question at this stage.
You've talked before about the Japanese model where low interest rates can mean just stagnation rather than recovery. Is that a real fear?
I'm concerned about it because some of the signs that we saw in Japan during the 1990s are now beginning to come through in the West. One of the more obvious signs is that money supply growth has collapsed, which is kind of intriguing given the fact that central banks have been supposedly printing money so aggressively. But with a collapse in money supply, very similar to Japan beginning of the 1990s, combination of that with low interest rates, we're not necessarily out of the woods.
Of course, another big problem is that the bailout hasn't come at no cost. Governments are running huge deficits. That clearly is going to be a problem going forward as well.
Yeah, I mean, in one sense, what's happened is that we've seen a redistribution of debt from households and from within the financial system to governments and hence to current and future taxpayers. And from a sort of Keynesian perspective, that was a perfectly sensible policy to pursue. The problem, though, is that governments now need to work out how they're going to cope with these extraordinarily large sizes of deficits and debts that have now come through. And, that's a question about tax increases, public spending cuts, questions about what happens to exchange rate policy, a whole bunch of issues that remain as big uncertainties over the course of the next couple of years.
And in the US and indeed in Europe, do you think that we're ready to see the stimulus package being withdrawn? Are consumers and companies ready to stand on their own 2 feet?
I think the situation has improved, but I'm not sure that we're actually at the stage now where we can guarantee that the recovery will come through without life support continuing. I think that for monetary policy, at least, we're going to see very low interest rates for quite a long period of time. My suspicion is that the Federal Reserve will keep rates at current levels throughout the course of 2010. Maybe some rate increases coming through in other parts of the world a little earlier. And of course, the really big focus at the moment is what's happening in the emerging world and in particular in China. One of the ironies, really, of the latest experience is that we used to worry about the Federal Reserve all the time. We now worry about the People's Bank of China.
Indeed, the beginning of this year, we've seen the stock markets not performing terribly well. Do you think now that they're really concerned that China will raise rates? I know you've been there recently. Do you think that's likely?
I think the markets are very concerned about this. We've already seen increases in reserve requirements for Chinese banks. We've seen cutbacks in terms of their ability to lend. We'll almost certainly see rate increases at some point during the course of this year. The fact of the matter is that China looked vulnerable last year, but it's growing like a steam train at the moment. It's growing incredibly quickly, and it needs to tighten policy through the course of this year. Now, if the financial markets have been betting on this idea of a strong emerging market-led story for global growth, and China is seen to be sort of holding back a little bit, then perhaps the situation globally is not quite so rosy as it appeared at the end of last year.
One of the other themes for Davos is, of course, going to be regulation after Obama's comments last week. Do you consider that it's going to be a problem if one country goes it alone? What effect is that going to have on global economy?
The thing to bear in mind is that the financial system is a global financial system, and arguably you want to have some sort of global approach towards regulation, an agreement at least between different countries as to how regulation should proceed. If you have regulations coming through in individual countries, it's a kind of backward step for globalization. And I think we shouldn't forget that globalization has been a huge benefit over the last 20 or 30 years. It's dragged many people out of poverty who were previously trapped in very, very poor conditions. Been a huge impact in terms of driving global growth forward. So if you start chipping away at that particular story through individual country regulation, it becomes more difficult.
The problem, of course, is that we haven't seen much consensus. Do you think that Davos is a good place to talk about that?
I think that Davos sees lots of people being nice to each other, but then later on during the course of the year may discover that nice behaviour doesn't quite continue. The truth of the matter is that last year there were high hopes on the G20. We thought there'd be some kind of G20 agreement in terms of regulation and financial market supervision of one sort or another. It appears that hasn't really been coming through, and therefore you've got a more unilateral action now beginning to come through from the United States.
Just before we leave it, I do have to ask you, do you think Ben Bernanke deserves to have another term at the Fed?
Well, I personally think he's done a very good job. If you can avoid the Great Depression Mark II, that's pretty good going. But obviously, it doesn't matter for the US administration and Congress and not for me.